All right, I'd like to take this opportunity to welcome everybody to today's event. Hi, Market Update 2022 Q1. Today's March 23rd. You got John Hopkins here. Tom Bowley going to jump in just 1 minute when we get this thing started. If you are new to Earnings Beats, the community, want to welcome you. Appreciate you taking the time to stop by. Hopefully you'll get a lot out of this event. I'm pretty sure you will. I'll tell you, when Tom speaks, I listen too. I'm taking my notes just like you are. We record all of our events. If for some reason you're unable to stick around, don't worry about it. Erin will send you a copy, as she always does, along with any links that are available. Tom's going to talk about a chart list tonight and a few other things that he wants to bring to people's attention. Well, this has been quite the market, Tom. Pretty straight up the last week or so. And finally today, the bull said, maybe I should lock some profits in. And I'm sure people are going to be curious about what you're thinking about today's action.
Yeah, today was really interesting because we did finally, I've been talking about how you really can't bet against this short-term uptrend until it ends. Well, today it ended. We saw selling into the close. So this was the first time in over a week that we actually closed on the lows of the day, as opposed to closing on or near the highs of the day. So we saw a little bit of a change there. From a daily perspective, we're still above the 20-day moving average, but there are, been mentioning to our members in our daily market report each day that we've got negative divergences that had formed on the hourly charts. So that suggested maybe our momentum was starting to slow to the upside. And we saw that really come to fruition there at the end of the day. So, last week, John, we had Max Payne, and you and I have been doing this for a long time. At the beginning of last week, I wrote to our members, and I think when I did the calculation on Tuesday, I said, I've never seen so many in the money puts on a net basis, net of calls, because the market had gone down so much heading into option expiration week. And what that tells us is that if you're on the short side, you might want to rein in that bearishness for a little bit and see what the market makers do heading into options expiration, because many times we get that reversal in what I call opposite George week, for those of you that are Seinfeld fans. And that's exactly what we saw. We had one of the biggest Max Payne related advances that I've ever seen since we've been doing this.
I'm putting that up in the top of the greatest Max Payne calls ever. It's got to be.
It was certainly one of them. If it wasn't the best, it was certainly one of them. And it doesn't tell us necessarily that we're going to go to Max Payne. It just tells us to be aware of the financial incentive that market makers have. And if you don't understand the role of market makers, you need to learn, because it makes a huge impact on trading. But anyway, so a lot of this rally that we've seen for the last 6 days a lot of it, I think, was options related. And so I said this week was going to be much more of a test on whether or not the market continues to go higher, or whether or not we have potentially another leg to the downside. And yesterday and Monday, we did okay. Monday was just kind of okay. We kind of closed where we opened. Yesterday looked like, okay, here we go, back to the upside. And then today we got a reversal. Going to be very, very interesting to see how the market reacts here over the next 2 days, and whether or not we see some of the selling kick back in. We'll see.
Well, I know that everybody's on pins and needles. Hear what you have to say. So I'll turn it over to you.
All right. Sounds good. Yeah, we got a lot to go over. I'm going to try to go through it as quickly as I can. If for whatever reason you can't stick around, we are recording. We always record our webinars, so you can always come back and listen later. We will timestamp the different areas of the market that we cover. Also, for those of you maybe who are new to Earnings Beats, who are not members, we do have a 30-day free trial. We'd love to have you come on board. We have another event next Wednesday, looking at, the various, maybe some of the different areas of the market that we should be looking for. We're in a secular bull market. I'm convinced of that. So if we do go down one more time, I think it's going to present some tremendous opportunities on the long side. So we're going to be talking more about those types of things next week, but that's going to be a members only event. And all you have to do is just be a 30-day free trial. It requires a credit card, but there will be no charge to your account. And we always reach out to all of our trial members before they expire, give them ample opportunity to cancel if our service isn't for you, but you should definitely check it out. If you like tonight's presentation, I think you'll love next week's. Also, we will be, and I'll bring it up here in just a little bit, but I'll show you a webinar special. We do these from time to time, and got a great special for anyone who wants to take us up on an annual membership. So if you're a current monthly member, current trial subscriber, or even if you're new to Earnings Beats tonight and you sign up, just for the 30-day trial, you could then sign up for an annual, and the special will begin at the end of your trial period. So you'll still get the rest of your trial period for free. Anyway, going to go over all that in a minute. But before we get into any of that, why don't we pull up the agenda for tonight? Because I got a few things that we're going to go through. Like I said, there's a ton of charts. If you have to leave, don't worry. We got it recorded. You can come back and take a look at it, and everything will be time-stamped by the topic that I discuss. So tonight, we're going to go through, we're going to take a brief look at the major index charts, Dow, S&P, NASDAQ, small caps, mid caps, blah, blah, blah. Then we're going to go through rotation and look at some of these rotation charts that I like to look at, the growth versus value and where we stand right now from a bigger picture perspective, not how we've done the last 4 or 5 days, because, if that's how we do all of our stock picking and investing and trading, we're probably going to be in a lot of trouble, because you don't really want to chase what happened last week. You want to be looking to see, is this rally sustainable to the upside? Is it not sustainable? What should we be looking for? I'm going to be looking at some of that during the growth versus value rotation, and also sustainability ratios that I like to look at. Then we're going to get into the dollar. I don't know if you've been paying attention to the dollar. The dollar keeps going higher and higher. And that has a major impact on commodities, and commodities is all the talk right now. Crude oil prices, many of these commodity prices that have been skyrocketing as a result of supply chain issues and so forth. What's the dollar telling us about the future of the commodities? We're going to go over that. Sentiment, I believe, and I said this going into 2022, sentiment needed to reset. The market, when you look at the options world, way too bullish. Everyone was, the last 2 years, we've seen the market do nothing but go up. Since that pandemic bottom, we just keep going up. And so those who are new to the stock market needed to wake up and smell the roses. And I think the roses now, I think we've seen here in the last 3 months, what might not be roses that you're smelling. I mean, it has not been a very good market, but sentiment, I think, still has a ways to go. And so that tells me we're probably not out of the woods just yet. And then the last thing we'll look at is cyclical bear markets, looking at the bottoms, trying to, understand that these things require patience. Maybe we bottomed when we hit our low in February. Maybe we didn't. But we'll look at some of the prior cyclical bear markets, because I believe we are in a cyclical bear market. And, sometimes I'll get comments, well, the S&P 500 only went down 14%. So technically it's not down 20%. It's not a bear market. If you want to go by that definition, okay, we're not in a bear market. But if you look at the NASDAQ, if you look at the tech stocks, if you look consumer discretionary, if you look at the small caps, small cap growth, mid cap growth, I mean, most of the market is down more than 20%. So if you want to, kind of split hairs and say, well, the S&P 500 is not down 20%. This is not a bear market. I can't argue with that. But in my opinion, we're in a bear market, and there's the potential for it to get worse before it gets better. And that's what we're going to be talking about some tonight. All right, so those are the topics for tonight. Before we get into any of that, I'm going to take you over to our website at Earnings Beats. Many of you are already either members at Earnings Beats or you're in our community. You've signed up for our Earnings Beats Digest newsletter. If you are in here and for whatever reason not a part of our Earnings Beats Digest community, we'll make sure that we have you set up. So you'll have, we'll make sure that you begin getting our newsletter 3 times a week. You can unsubscribe to that at any time, by the way, no credit card required. So it's a great way to learn a little bit more about how we approach the market. But if you go to Earnings Beats right now, to our homepage, you're going to see this. It was just set up literally minutes ago. We are offering this special to basically anybody in our community, but especially we wanted to point it out for all of you who are taking time to join us tonight for this event. If you click on that special, we are going to have this offer valid through the end of this week. So through Friday at midnight. So you got a couple of days to, take a look at it. That's why if you're not currently a paid member and you want to take us up for our trial, 30 days for free, you can check it out. And if over the next couple of days you say, hey, you know what, I really like this, I want to give it a shot, you'll get the rest of your 30-day trial. Plus, we'll give you 13 months for the price of 12. So technically, if you're just joining, you'd get 14 months because you get your trial period as well. But anyway, for $9.97, that's a huge savings for anybody who takes us or is a member at Earnings Beats, and as a monthly member, you pay $147 a month. $997 for 13 months works out to be a whole lot less than $147. It's probably close. Well, there's your savings, 47% savings. So if you want to lock in, if you like our service, you want to lock in, this is a great time to do it. I just want to mention that. I'll probably pull this up later in the webinar as well, just to make sure everybody is aware of it and to remind everyone that it'll be there for the next couple of days. All right, let's get going because we have got a lot to cover. So I want to start first with index charts. As I look at the NASDAQ and the S&P and the Dow, this is a chart of the Dow right here. I'm seeing a downtrend, and a downtrend consists of lower lows, lower highs, lower low, so far lower high. You can see that big red candle. We hadn't seen any of those for a while. Kind of been, just meandering back to the upside. It's been really good. All of a sudden today, you can see the Dow finished down 449 points, a lot of it this afternoon. And we did not close well. If you look at a 5-day, 10-minute chart, you can see we finished right on the low today. So after a move down, little meandering to the downside, looked like we were going to stage a rally. Didn't happen. Came back down, closed at the low of the day. So at this point, I would say we've got to at least respect the downtrend. But the theme here on all of our index charts, I would say, is watch the rising 20-day EMA. We have negative divergences on the short-term 60-minute charts across many of our key indices. That could lead us down to a 50 period or a 50-hour test. On the Dow, here was the higher high. This is an hourly chart that goes back 1 month. Higher high, lower PPO. A lot of times what we see is that 50 period test. That would be another, 34,358 down to 34,225. So we're talking about another 130 points to the downside to kind of reset the issue we have on the hourly chart. Okay, so the 50-hour is at 34,225. If you go to the 20-day EMA, it's at 34,027. So that'd be another couple hundred points to get down to this 20-day. Also, I'll mention, we had a double top in here at the end of February and early March, right around 34,000, just above. So if we go back down and we lose 34,000, we're going to be losing a lot of key support in the short term on the Dow. And that, in my opinion, would begin to set up another move down to test these lows. I'm not saying we're going there. I'm saying that would be an additional warning sign to me based on price action if we cannot hold that rising 20-day EMA and this area of price support. Now, S&P, all these other charts are going to be fairly similar. So I don't want to spend a lot of time because we got a lot to go over. But basically down, up, we're still in the downtrend. We've got to clear 4,600 on the S&P 500. We haven't done it yet. And you can see we closed on the low today and we took out the prior day's low. So we're starting to at least see the beginning of what could be the market rolling over. Do we hold the rising 20-day? Do we hold price support around 4,400? We're going to have to wait to see. We don't know based on today's action. The NASDAQ did put in a higher low. I mean, even at today's close, it was higher. So we haven't broken our streak of higher lows yet, but we did close on the low. So anything tomorrow to the downside on the NASDAQ and the higher low streak will be over. So far, so good. NASDAQ's going to probably need a gap up tomorrow, though, to hang on to this streak of higher highs and higher lows. To the downside, again, you've got your price support rising up here just a little above 13,500. You got the recent price resistance, which now becomes support, probably at about 13,850 or so. Can it hold? Can those two levels hold? NASDAQ 100 is not going to be much different, very similar to what we just looked at, so I'm not going to spend any more time here. Mid caps, I mean, if you think that the mid caps are in better shape, well, I would disagree. I think we've got downtrend. There's your lower high, lower low, lower high, lower low, but it was kind of an intraday kind of a thing. So I would just say right now we've got support down around 2,500, 25, somewhere in there. To the upside, we went back and challenged this high, couldn't get through, and look at that action today. Very, very large move to the downside, almost 2% on the mid cap index. So rolling over after testing resistance at about 27.25. So right now we've got this range, 2,500 to 27.25. And if you think that's a wide range, it is 10%. That's a big range, but we've got a lot of volatility in the market and we could go back and forth. Small cap index. This was the one that I thought looked the best because we actually, if you notice, we had this double bottom at 1320, came back up, put in this double top at 1330. So right in this area, I thought we had some pretty good resistance. You know, we went through the 20, went through the 50. We're actually getting a golden cross where the 20 is now moving above the 50. Well, that's all great until price action moves below the moving averages. We did fail to hold this breakout level that we just had earlier this week, actually the end of last week. Now we're moving back down. Do we hold the moving averages? If not, look for this double bottom to be retested. So these are your 6 key index charts that I wanted to show you. And, you know, short term, we're still above our moving averages. Good. That's the good news. Long term, though, or maybe even not long term, intermediate term, we're in a downtrend. And so if we start to lose these moving averages, I think we have to fall back on that longer term, the medium term charts that we're seeing, which are showing downtrends. So just be aware if these support levels start to give, don't be surprised if the selling begins to escalate again. All right, next up, let's talk a little bit about the growth versus value, this rotation in the market. So since really the end of November, we have been seeing the various areas of growth relative to value downtrend. So the market has been, we've been seeing rotation from growth to value. That's not the best recipe for the stock market. When you're in a secular bull market and you're advancing to the upside, you want to see growth stocks, the more aggressive growth stocks leading to the upside. Because in a secular bull market advance, normally the economy is strengthening. And as a result of the economy strengthening, growth stocks are able to grow their earnings much more rapidly than value stocks. And so by following this ratio, you can just get a quick sense of where the market is rotating. Does the market believe we're going higher in the form of a strengthening economy and higher growth prices? Well, since the end of November, you can see the large caps have been downtrending. Now, the last week, remember, a lot of this was options related last week. I don't trust that. I mean, yeah, on the surface, it's a great move. Those who know nothing about the options market and Max Payne probably thinking this is it. This is the end of all the weakness that we've seen. Let's just go. Let's rally again. I don't know if you're watching the equity only put call ratio. I'm going to talk about that a little bit later in the sentiment portion. But all of a sudden, all the calls are being bought again versus puts, just like everything's back to normal again. I would be a little cautious taking that approach. That's not the way I'm looking at the market right now. Could we have bottomed? Yes, we could have bottomed. I'm still open to the possibility that we either continue going higher or that we roll over and potentially even put in a new low as we go forward here. So just try to remain objective when you're looking at this. You can see growth versus value started to roll over today, right at that 50-day moving average. So as the S&P comes roaring back here, we've seen growth outperforming, but we haven't seen what I would say is any major breakout in growth versus value. You know, we're still in this overall downtrend. And like I said, we might be rolling back over again right now. The good news is down here at the very bottom of this chart, I have a 20-day rate of change on the relative strength of growth versus value at the large cap level. And right now it's as strong as it's been in 2022. So we've had a nice little rally. Keep in mind though, this is a 20-day rate of change. It's 20 trading days, which is roughly 1 month. So you got to think about where we were a month ago and where we are now. So here's where we are now. Here's where we were a month ago. So this is what it's comparing. Well, guess what? It's going to stop. It's going to start dropping because over the next week or so at the end of February, we were going higher. So if this starts to roll over, that 20-day change is going to begin to go negative. So yeah, it looks really good right now, but unless growth stocks continue to tear higher, this is going to start to roll back over again. And if it starts to trend back to the downside, we want to be really careful, really careful. So that's large cap versus large cap growth versus value. Here's mid cap growth versus value. Dow Jones US mid cap growth index divided by the US mid cap value index. We topped here back in September and we've been downtrending. Now, I've seen some folks saying, yeah, but we're doing better in mid caps and small caps recently. Well, that's true. That's a fair statement. Have we made any kind of major breakout here on this? I don't think so. We had a relative high at the beginning of March right here at 1.275. Looks like we're rolling over. The large cap just started to roll over. It looks like mid caps began rolling over at the end of last week or at the beginning of this week. So I'm not seeing anything yet on the mid cap, in the mid cap area, that makes me believe that we've got some kind of bottom in place. Again, money starting to rotate again away from growth. Got to be careful. Small cap growth versus small cap value looks much the same to me as what we just looked at with the mid caps. You know, maybe we're not quite as steep anymore as we were with the, you know, if we go back to the large cap, see these big moves, big move, rally, big move, little rally, another big move. We're kind of, you know, we've been picking up the pace in terms of selling off of the large cap growth over the last few months. So that might make it seem like small caps are doing so much better because we're not really, you know, here we kind of held our own at the bottom. We went a little bit lower here and now we rallied back. I think it's giving us a false sense of security. I don't see anything on this chart telling me that small cap growth, large or mid cap growth are much different than the large cap growth. I still see them all trending lower. I see them all starting to roll over again. Now, if tomorrow or the next day or next week, all of a sudden the market perks back up, we go to new highs and we see these ratios take off, I'm going to start thinking more that we have a bottom in place. So again, this week, I think is much more important. What the market does this week is a lot more important than what it did last week. There was a lot of financial incentive for market makers to drive prices higher last week. That's no longer the case. So let's see what happens when there's no more money to be stolen. That's on the table. And when I say stolen, I don't mean it literally because they haven't done anything wrong from a legal standpoint. But the way our setup, you know, the way our market system is set up, market makers have financial incentive to use their own capital to move prices in one direction or another for a short period of time. Believe me, the amount of money that's in the stock market and trades daily, it overwhelms what market makers have. It's not like market makers are capable of absorbing everything in the market. They're not that big. They don't have that much in the way of resources. So I think it's important that you understand their limitations. But in the short term, you know, if you could commit your money and influence the market in the very near term to go up for a couple of days, would you? If you could make a lot more money, probably would. I mean, that's what most of us do when we're in business. We try to do whatever it takes to make more money. So don't put it past market makers on, you know, what they've done here or what they did last week. Just a couple more of these. Next one, IWF, IWD. This is very similar to the large cap growth versus large cap value that I showed you just a few charts ago. Only difference is this is more of the mega cap growth. So I would say it's, you know, the Apples and the Microsofts, they have a more of a weighting in the IWF than they do in the Dow Jones US large cap index. So this is just taking a look maybe at even a higher level of growth, the mega cap stocks. And once again, we've rebounded really nicely, but 2022 has not been kind to this group. And we were really oversold heading into option expiration week. And most of this comeback was during option expiration week. And now we're starting to roll over. Just be careful. That's my theme. Just be careful. QQQ versus the spider. Very similar. This is going to be mostly large cap, the NASDAQ 100. QQQ is an ETF that tracks the NASDAQ 100. And that's 100 of the largest companies on the NASDAQ, or 100. That is the 100 largest companies. So you've got, this relative ratio strengthening, but I still believe we have an overall downtrend in play. Once again, a lot of this last week, options related. Got to be careful. All right, so that's it for the rotation from growth to value. Now let's look at sustainability ratios. And so what I'm looking for here on sustainability ratios is, are we seeing money rotating in a fashion that would support the current direction of the stock market? And my favorite sustainability ratio is the XLY versus the XLP. To me, it just makes common sense. If we look at our GDP, I mean, what really drives the stock market is the growth of our economy. So if the GDP is going up, usually the stock market's going up. If the GDP slows and we have a recession, that's when we tend to see the market pull back, usually ahead of time. It's not, nobody's going to come out and say, oh, we just had a recession the last 6 months, by the way, and then the market goes down. That's not the way it works. The market anticipates. We've had consumer sentiment dropping for the last year. That's a really good signal that an impending recession is, probably at our doorstep, and we don't even know it. So don't expect the market to wait for the announcement that we could be in a recession. A lot of what we're seeing right now in the market, inflation is going to be taken care of one way or another. This is not the 1970s. If you want to believe that, we could have a debate about it. I don't believe that at all. Is it worse than what I thought maybe it would be a year ago? Yeah, I'd say it probably is. I didn't think it would last this long. Fed didn't either. Fed didn't even want to raise rates for a long time. Now the Fed's raising rates. I think they're probably going to end their rate raising campaign long before they think they are, because I think over the next couple of months, unless inflation really picks up, I think we're going to start seeing the annual rate of inflation come down. And so if the market goes down one more time, one of the things I'm going to be looking at is the ratios between the growth and the value, because if the growth versus value ratio doesn't go to a new low while the S&P 500 is at a new low, that's going to be a sign to me that Wall Street is definitely rotating out of value and back into growth. And that's a good sign. So this could be the start. What we've seen over the last week to 7 days, 6 days, whatever, it could be a start of a potential bottom printing, but that doesn't mean we don't go lower on the indices one more time. And that's kind of where I am right now. I still think there's better than a 50-50 chance. I'll call it 60-40 that we put another low in on the S&P 500 before this is all said and done. Anyway, XLY, XLP, the reason I like to follow this particular ratio is that within our GDP, there's an estimate about 2/3 of our GDP is consumer spending. So doesn't it just make sense that we want to see where Wall Street is putting their money? Are they putting it in consumer discretionary stocks, which are more aggressive? These are the companies that sell us the things that we want. Or is the money rotating more into consumer staples, which is the defensive area of consumer spending, where these companies sell us the things we need, not the things we want, but the things we need? I have yet to hear anyone say, oh my gosh, we're going into a recession. That's it. I'm not buying any more toothpaste. I mean, that doesn't happen. I hope not. If it does, I always, kind of joke, I'm glad this is an online webinar. I don't want to be around everybody if they're giving up on toothpaste. Deodorant? No. Stick with it through thick and thin, please. So the relationship here is really important because it gives us kind of it's almost like it's the pulse of the market. And so I like to find out, if we're breaking out on the S&P 500, are we breaking out on the XLY, XLP? Let me give you a perfect example. Look back in October. October, S&P 500 breaks out to a new high. XLY, XLP breaks out to a new high. That's confirming that move to the upside. Now look at what happened in December, actually from about the latter part of November. Notice how the S&P 500 went up one more time. And look at the ratio here in the consumer area. Does that not tell you that Wall Street is moving more into consumer staples? This isn't my opinion. This isn't an opinion chart. This is a fact. This is where the money's going. They can say whatever they want on CNBC and all the media outlets. They can talk about that all-time high on the S&P 500 all they want. You can go back and read my blog articles at the end of December. I wasn't cheerleading. I was saying we've got problems. At the January 8th Market Vision 2022 event, we do these every year at the beginning of the year. I was talking about the potential of a correction, maybe even a bear market on January 8th. That, market hadn't really fallen much. I mean, here's January. We might, pulled back a little bit here. This all came after all these warnings. I'm not a genius. I'm just watching the charts. I'm just following. The charts tell us a story. Wall Street is telling us what they're doing with their money right here. We don't need to hear it on CNBC. Who knows what they're talking about? They don't talk about this. This is what you got to focus on. So, have we bottomed? Well, at the most recent bottom right here, the XLY, XLP was still setting a new low. I mean, yeah, we bounced, but we're going to bounce almost any time the S&P 500 bounces. What I want to see is if we go back to a new low and we set a new low on the S&P 500, what I would love to see is that the XLY, XLP does not set a new low. It can come back down, but maybe it stops just above this low, whereas price action, maybe we go to 3,800. That would be your 20%. For those of you that need to see 20% on a, to call this a bear market, that would be your 20%, 3,800. If we go down there and this ratio holds up and doesn't break below that early March low, that would be a wonderful sign to begin thinking about buying. All right, so that's, I spent a lot of time, but this is one of my favorite ratios. Anybody who's a Earnings Beats member or reads my blogs or listens to my shows knows about the XLY, XLP because I talk about it all the time. It's that important. Transports utilities. This is another sustainability ratio. So here, topped in November, by the way. Why is this one important? Well, why would transports go up? I mean, there's really only one reason: stronger economy. I mean, transportation companies ship goods. If the economy is going to go down, number of goods being shipped is going to go down. So that's a really easy one. Transportation stocks do well when the economy is strong or expected to strengthen. Utility stocks tend to do better on a relative basis, especially when things are bad. They're more of a safe haven, more defensive area. So, you would be wanting to get into transports. Transports would be leading during good markets. Look at December. Look at the high on the S&P 500. Look at transports versus utilities. Again, this isn't my opinion. This is Wall Street with all of its billions, with trillions of dollars. All the money moving out of transports and into utilities on a relative basis, while the S&P is setting a new all-time high. Yay! Cheerleading, CNBC, new all-time high, beginning of January. Anybody see the relative chart, transports versus utilities, show up on CNBC? Anybody see the XLY, XLP relative chart showing up on CNBC? I don't think so. I wasn't watching, so I couldn't tell you, but I doubt it was mentioned. Now, we just had a nice rally, got right back up to this high, but look at what's happening here since the end of last week. Again, most of this move was made during option expiration week. Now, all of a sudden, there's no financial incentive. Oh, let's roll back over again. The theme, be careful. How about copper and gold? Now, this is an interesting chart. And you might say, what the heck? Why would we look at copper versus gold? Well, believe it or not, when the stock market is strong, copper usually soars versus gold. This is a 1-year chart. Let me stretch this out for you. How about, I don't know, let's go 10 years. Now, if you look at a 10-year chart, look at when the stock market does its best. From the pandemic low all the way up through, I mean, we're about even with where we were in April of last year. So if you look at basically that period right there, look at copper versus gold. How about, remember at the end of 2016, right before the election, looked like the market was rolling over and going to break down. And then all of a sudden we had this great period with almost no volatility. It was one of the, I think it was the longest stretch in history, 500 and some days, where the S&P 500 never went down more than 3% ever in this entire period. Not in a day. I mean, even if you stretched a week or two together, you never had a 3% decline. One of the best periods that we've seen in the stock market. By the way, copper bottomed here and topped right at about the time we topped in the beginning of January 2018. Huge move up. How about, you remember 2013, 2012, going into 2013, into early 2014? That was a very strong move up in the S&P. Look at copper versus gold. So that's telling us that normally, if the market's in really good shape, copper, which is more, more industrial. So if the global economy is strong, there's going to be more demand for copper. And so copper prices should rise. Gold, on the other hand, when things are hopping along, the economy's strong and markets are good, not too many people turn to gold. Gold actually becomes more popular when the market struggles. So if we look at this ratio, it helps us just get a sense of what these two markets are telling us about the mentality of the stock market. And if you look at this weakness or this choppiness that we've seen now over the course of the last almost year, I mean, we got down to 4,100 and change. And here we were at, 4,100 probably back in April or May of last year. So almost a year ago. All of this sideways action is occurring when gold can't make up its mind. Copper can't make up its mind versus gold going sideways. All this choppiness occurred when copper is going down. All of this choppiness occurred when copper is going down versus gold. So look at what's going on right now. Is this giving us any kind of bullish signal? Not yet. I'll feel really good if the stock market's going up and all of a sudden we see this huge breakout in copper versus gold. So this is another sustainability ratio to keep an eye on. All right, so that's it for the sustainability ratios. Let's move on now. And I thought what we do now is take a look at the dollar and commodities. My favorite chart in trying to understand the direction of the dollar is to look at the relationship between our treasury yields, our 10-year treasury yield here in the US versus the 10-year treasury yield in Germany. And that might just seem like, well, why Germany? Why? What is this doing? Well, when I studied economics back, 1980s, early 1980s, we weren't a global economy. And so what we would look at is we would look for, strength in the economy, and we'd look for interest rates, the direction of interest rates here in the US to tell us which way the dollar was going to go. If rates were moving higher and the economy was strengthening, that would normally lead to a stronger currency. Well, now that we've got global markets and everything is so intertwined and interrelated, it's important to see how the treasury yields are doing in the US versus the treasury yields in other parts of the world. Now, I picked Germany because if you look at our markets and Germany's markets, bond, stock, everything else, there is a stronger correlation between us and Germany than any other country that I've looked at. So what's going on in the US and what's going on in Germany tend to kind of is very important. A lot of people always talk about China. Well, China's got all these people and blah, 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 blah. Look at a long-term correlation between the US and China. You flip a coin. US market goes up, China goes down. China goes up, US market goes down. I mean, literally it's 50-50 on whether or not the two are going to go hand in hand. Us in Germany, on the other hand, we tend to go hand in hand. When our stock market's going up, theirs tends to go up. When our economy tanks, theirs tends to tank, and so forth. So looking to see which economy is stronger helps determine many times the strength of the dollar or the weakness of the dollar. So on this chart, this top panel is the difference between the yields of our US treasuries, the 10-year treasury, and the German 10-year treasury yield. That's all this is. It's just plotting the difference. So if ours is 2.3% and theirs is 0.3%, then it would just be 2 showing up. That's where we would plot it. And if that spread widens, then we would see it go up. And when the spread narrows, we'd see it come down. Now, if you look at this chart, down here on the bottom is the dollar. This goes back to the last 15 years. So here's the yield versus our yield versus Germany, the difference in the spreads. Excuse me. And then down at the bottom is a dollar. Do you see kind of a pretty tight positive correlation? When our yields in the US go up versus Germany, our dollar tends to go up. And when the yields go down, I mean, here's a period right here, yields versus Germany going down for about 18 months. Look at what the dollar does, goes down. Now we have these periods from time to time where we don't have perfect correlation. Down here's the correlation. I think if you look at this, this is the correlation between the difference in spreads between our two countries, US versus Germany, and the direction of the dollar. I think it's pretty clear to see that we spend the majority of our time in positive territory, many times up near 1.0. And if we, just highlighted the times that we're above 0.5, I think you could say that we reside up in that area quite often. How about down here at the bottom? I drew a line at minus 0.5. That's the exception to the rule. That doesn't happen very often. So the whole point here is that I think there's a lot of, there's a lot to be said about this chart in terms of helping us determine the direction of the dollar. And I'll tell you why the direction of the dollar is important in a minute. So we've got yields right now in the US. Look right here. We're turning up again. We're about to move to about a 2-year high. Since the pandemic, we had a high at the end of March, early April. We're getting close to that level in terms of the spread between the US Treasury yield and Germany's Treasury yield. And look at the dollar going up. So here we go, up to the upside with the yield spread and up with the dollar. So I think things look pretty clear here that right now, what I would expect is the dollar to continue going higher. And the reason that this is important, I want you to look at the dollar, this top part of this chart. Another chart that goes back 20 years. This part up here is the US dollar index. So here back in 2002 to 2008, it was going down. After choppiness, 2008 to 2011, I think you can see pretty clearly we're going up. Now, we did break a trend line in 2020, but we never went below that low. So I think the overall trend remains to the upside here. Until we break down below 88, I would say the dollar remains in an uptrend. All right, now let's look at the relative strength of energy and materials. When the dollar is going down, like it was 2002 to 2008, energy outperforms, materials outperform. When the dollar's choppy, energy is choppy, materials are choppy on a relative basis. Okay, relative basis. We're comparing the energy ETF, the XLE, to the S&P 500. So this is just telling us that energy is outperforming. Energy was going higher, but it doesn't necessarily, relative strength doesn't always equate to absolute strength. All this is telling us is that when the dollar is going down, energy tends to outperform and materials tend to outperform. When the dollar is rising, energy tends to underperform. Materials tend to underperform. Now, we have periods when we outperform, but overall, energy tends to go down. Now, you remember, crude oil prices after the pandemic went negative. If you were willing to sacrifice your swimming pool to store crude oil, you would have been paid money to put crude oil in your swimming pool. The price of crude oil went negative, and energy stocks were clobbered. I mean, look at where we are, even though energy, and I know that's the talk of the town right now. My gosh, energy, you got to be in energy, got to be in energy. Yeah, I mean, I'm not going to argue it's been outperforming. It's been a huge outperformer here in 2022. I think some of it is also related to the fact that now we have the Russian conflict with Ukraine. That's putting a lot of pressure on oil prices because supply is going to be limited. Sanctions everywhere. Nobody wants to buy Russian crude now. And so as a result, you've got supply dwindling, and the market, the global economy at this point, still pretty strong. So you got demand that's still up there with dwindling supply. This is economics 101. That's what it's driving crude oil prices higher. That's just another problem that we're going to face in terms of trying to avoid a recession. I mean, if you look back, crude oil topped in 2008. We know what happened to our economy after that. Crude oil went crazy, up to $147 a barrel or whatever. We're not back to that level, but we've definitely been rising. Anyhow, my point here is that if the dollar keeps going up, you better make sure you have your stops in play. I'm okay with energy while it's outperforming, being part of your portfolio or trading it, whatever. Just beware that this is a very unusual period where we see the dollar going up and we see energy outperforming. I'm not saying that it's never happened before, but most of the time, the overall movement to the upside in the dollar generally results in relative weakness in energy. Now, if you look at 2017, dollar was coming down and energy underperformed. So again, they can go in the same direction for a period of time, but the normal pattern is when the dollar's going up, energy underperforms. So I just don't believe we're going to continue to see this for an extended period of time. So which one of these gives? Does the dollar give way to the downside, which then allows energy to continue pushing higher on a relative basis? Or is it the other way around? I think if the economy is weak and we see global recession, I think the dollar is going to be the safety net. It usually is. So I don't see the dollar coming down, but that's just my opinion. You can feel free to disagree. That's what makes a market. Not everybody's going to agree. If it was that easy, it would never be that easy, because this is what makes the market go round. This is what makes the market makers all their money. Everybody betting different sides. Okay, next up. So let's take a look at the dollar versus gold and silver. Same chart here at the top, the dollar. Nothing's changed, 20 years, trending higher. I just want to show you, here is the CRB index relative to the S&P 500. So this is, I don't know what the percentage is anymore. I know at one point it was like 40% crude, energy. But here's gold relative to the S&P 500, and here's silver relative to the S&P 500. So when you start thinking, and I said this earlier, recently when I was talking up gold in the near term, when volatility is rising, gold can be a great investment. When everybody is scared out of their mind, they'll buy gold. Everybody goes, turns into gold. That's why when the VIX is moving up, gold can be a great short-term hedge or investment. But once the volatility picks up and we get to a certain level, you probably are in a position where you want to maybe book those profits in gold. Look at the long-term relative strength. I mean, outside of this period during the pandemic, that's where gold outperformed quite a bit. This recent market downturn, we saw panic starting to pick up. Gold did well. 2016, remember, it looked like the S&P 500 was going to break down. Gold outperformed. But other than that, why would you want to be in gold? Long term, I want no part of gold. These, folks are saying gold, it's going to be at 5,000, in the next year. I'm not buying into any of that. Still comes down to demand versus supply. When interest rates are sitting still down near historic levels, gold versus the stock market, I will take the stock market every single time. Just historically. So anyway, I think the dollar is going to continue to be strong. And that's why I think you've got to make sure you have your stops in play on energy and material stocks. Because if I'm right about inflation not really being a problem long term, some of these stocks that are being bid up right now are going to come back down in a hurry. And usually when they come back down, they don't come back down in little tiny increments and give you great opportunities to just get out at your leisure. They usually take gigantic moves to the downside. And so just keep all that in mind. Make sure you have your stops in play. It's better to grab a slightly lower profit than to sit there and scratch your head or double down and, bet against the market when we start to see movement to the downside. All right, next, sentiment. Let's talk about sentiment. This was a chart that I showed back in January at our Market Vision 2022. Right here, this is a 253-day moving average of the equity-only put-call ratio. Why in the world would I want to look at a 1 year? 253 days, trading days is roughly 1 year. Why would I want to look at a 1 year moving average? What's just kind of getting a sense, taking a pulse of the market from a sentiment perspective, because the market, when it's going up, it tends to get too bullish in the options world. We start seeing way too many calls being bought, and we'll print bottoms. Look at the bottom here in 2006. Look at the bottom in 2011. Look at the bottom in 2014. Look at this double bottom right here at the end of 2021. These are all signals that there was too much bullishness in the market. And at that point, that's normally when we see the market struggle. So when you go into a period where you have to reset sentiment back to the upside, look at what happens to the S&P 500. So here we're going down, market's bullish, market's going up, but we reach a point of an extreme point. In this case, it was around 0.60. So the moving average of the last 253 days was basically 0.6 puts being traded for every one call. Now, as you get higher and higher, like this 0.775 or 0.78 high, that means more puts are being bought. So as the market is going down, people are getting a lot more fearful. This is the perfect example of retail traders chasing. They follow the masses. And so when the market starts going down, they don't believe the market can do anything but go down. And so they start piling more and more on the put side, driving this higher and higher. Well, when we top out and we start rolling over, look at what happens to the market. Notice that 1 year moving average, when it topped, it perfectly coincided with the market bottom. When this bottom hit, it essentially perfectly coincided with the choppiness that lied ahead. Then we get to this top, come back down. Look at the beautiful market action we had. It all started with that peak. Sentiment was reset. There was a lot more bearishness at this point. That's good. That's exactly what we want. We want everybody to turn bearish, because what it's telling us is that folks don't believe they've sold. You start running out of sellers. And so the market at that point begins to rebound. So here you go. We roll over, the market rebounds. Then we get too complacent again. And we start resetting sentiment. And what happens during that period? Stock market goes nowhere. There were too many buyers here. Too many folks were believing the market couldn't go anywhere but up. And when you get that imbalance and everybody's bullish, that's when you got to be very careful. Make the move up. We top again. What happens when we top? We didn't catch the exact bottom, but from July of 2016, we went up 47% in just a little over 2 years on the S&P 500, after we got to a point where everybody thought the market couldn't do anything but go down. That's when the market started going up. This period right in here with the trade war, all the choppiness that we went through, and then the pandemic, I just kind of, I guess you could break it down to all these little mini moves, and that's what I kind of did here. But basically, all this choppiness just resulted in the market being very choppy. Now look at what happened since the pandemic. We went down and printed lows in options like we have never seen before. I've heard some folks talk about how everybody's so bearish. Well, let me tell you something. If everybody's so bearish, I don't know why they're buying calls versus puts. This is telling us that the number of puts is dwindling and dwindling and dwindling, and it was going on for a long time. And while all of this bearishness was waning and we were getting more and more bullish, everybody was following the stock market to the upside. People that were coming in after the pandemic, they had never really traded the stock market before. Everybody had to stay home. That's when Reddit was born. All these traders don't know anything except straight up. And you can see it in the options world. Where were we going to go from here? Once again, I ask you, look at where we bottomed in the past and look at the market we had seen, what we saw going forward after that. See this? Now, here we went up, we went down, went up, we came back down. Here we went down, we came back up. It doesn't mean that we're going to go down the whole time that this is going up. It's just that we need this pause. We need choppiness. We need something to drive people more, to make them more bearish. Well, you don't do that with the S&P going to new highs. We reset sentiment by choppiness, by selling. Yes, we'll get rebounds from time to time, but we need folks to think, oh, this is it. We're going right back up. And then they need to have the carpet pulled out from under them. I mean, I hate to say that because I hate to see the market go down. But from a sentiment perspective, look at where we are right now. We're at 0.51. The last 3 market tops occurred at 0.575 or higher. This one was at we were down at 0.46, 0.455. Crazy. Now, because we're in a secular bull market, I don't think we're going to see the 253-day moving average get to these peaks. I really don't. I think probably what we're going to see is maybe we get up to the bottoms here. Maybe we get to 0.55, 0.575. That might be enough. But let's watch for it and let's wait until this at least starts to give us a sense of turning. I mean, it's going up right now. So yeah, in the short term, we're seeing the bullishness kind of kick back in again because the market's strong. But the 253-day moving average isn't budging to the downside. It's still going higher. And I think we're going to continue to see it go higher, especially if the market rolls over again. Again, I think there's probably a 60-40 chance we're going higher, or lower and setting a new low. I would say it's probably 80-20 or maybe even 90-10 that we don't set a new all-time high on the S&P 500 again until the fourth quarter. I just don't see it. I mean, maybe we go right back up again. I mean, it's certainly possible. I just don't think it's likely based on what I'm seeing. So look at this sentiment. Again, we went up 112% in the 2 years following. Well, actually, we went up a little bit more than that. I think we went up to about 120%. But 112 when this low right here was set back in the fourth quarter of 2021. And since then, during this period, now we're down, 13, 14% on the S&P 500. And, again, maybe we, do all this choppiness, kind of like we saw, here, kind of like we saw here, when we were rising, when the put call ratio was rising, all this choppiness. Here we're rising, choppiness. This was actually a secular bear market. I don't believe we're in a secular bear market. That's why I don't think we're going to see this huge 50% decline. I don't see that at all. I mean, could we go down to 35, 3,800 in here? I mean, that's where we broke out from, 35, 3,600. I think it's possible. I think if you're trying to be objective and rational, listen, I'm mostly a bull. People have called me perma bull in the past. I don't think I'm a perma bull. Just market goes up more than it goes down, so I'm going to be pretty bullish. But if I see warning signs, I have no problems being out of the market or even potentially shorting when I see opportunities. I'm not a perma bull. But I also realize the market goes up a lot more than it goes down, and I do think we're in an extended period of upward movement in the S&P 500 that I think began in 2013 when we cleared the all-time highs on the S&P 500. If you remember kind of picturing the highs on the S&P from 2000 and 2007, it was right around 1,500, 1,550, something in there, that range. We broke out above that on April 10th, 2013. That to me kicked off what could be a 20-year secular bull market. Now, within that secular bull market, here we had all this problem 2015, 2016. We had the trade war. We had a cyclical bear market. We had the pandemic, which is just difficult for anybody to call, but didn't last long. Why? Because we're in a secular bull market. Interest rates were near zero. Where else are you going to put your money? I mean, if companies can begin rising in terms of their earnings, if their earnings start to grow in a near zero interest rate environment, those earnings are worth gazillions. I mean, the earnings are, anytime interest rates are near zero, if you can start growing your earnings 30, 40, 50, 60% a year, my gosh, that earnings growth is extremely valuable. So we saw that move, but I think we need to pay the piper now. And so as a result, all the Reddit folks been buying calls and thinking, bidding companies like GameStop up into the stratosphere. What was it? $5 or $7 went up near $500. I mean, that kind of craziness and that mentality, that sentiment level, like we saw, has to be reset. And I think we're in the process. So sentiment, I think, is a big part of what we're looking at right now. And, could we top right here and start to roll back over and the market takes off? Of course we can. Market can do anything. Do I think that's going to happen? No, I don't. I think I think we need to reset this more just based on history. Again, 0.55, 0.575, maybe 0.60. I don't know where we go to, but I think we're going to go higher than we are right now. Next thing I want you to see, the S&P 500 versus the 5-day moving average of the equity only put call ratio. Now, when you look at the S&P 500 moving higher, again, this is the 5-day moving average, not 253-day moving average, 5-day moving average. Now, if you want to know why the 253-day moving average got so low, well, look at what the 5-day moving average did for this entire period. I mean, the put call ratio went down to levels and stayed down there, levels that we had never seen. All of these moves down below 0.55, these 5-day moving averages, if you look, many of them coincided with market tops, even if it was just short term. Market was just getting too complacent. All of a sudden, after the pandemic, it was like, it was free money. It was ATM printing money. Market just kept going higher and higher. Everybody buying calls like nobody's business. It never marked tops. Look at it. I mean, we just kept going higher and higher despite everybody buying calls. Well, I think that's caught up to us now. And what's interesting here is if you notice these high readings, 0.80, that's where you have 4 puts to every 5 calls being bought. And this would be over a 5-day moving average. Anytime we've gotten up to that 0.80 level, look at the green arrows and what the S&P 500 does. Sentiment can do an okay job calling tops. Sentiment is really powerful at calling bottoms. I mean, humans are so predictable. When everything is looking horrible in the market, what do humans do? They sell. Can't take the pain anymore. They make excuses and make excuses and make excuses for the market going down. It's okay. I'm a long-term holder, not a problem. I'm okay. And then when that panic really starts to set in, it's amazing how many of those long-term buy and holders finally say, you know what? I can't take this anymore. This is my life savings and I've lost 35%. And I got to get rid of everything. I just need to move to cash for peace of mind. And when everybody starts to do that, and everybody starts betting that the market can't do anything but go down, the market bottoms. And sentiment, when you get into these highly volatile periods, this is what I always talk about and try to educate. Sentiment is how you mark bottoms. Forget about moving averages. Forget about last price support. When the market is fearful and panic, there's only one thing that matters. You got to see the kitchen or the the baby being thrown out with the bath water. You got to see the kitchen sink being thrown in. That's what marks bottoms, not last week's low or the low from 6 months ago. Market goes through those levels like a hot knife through butter. I call it market makers going on vacation. We don't have buyers. The one group dedicated to providing liquidity during panic sell-offs goes on vacation. They're like, we'll be back in a few days or a week or whatever it takes. You guys have fun now. And everybody's selling, and market makers, if anything, they're on the short side, driving prices lower. That's why when you see these moves to the downside, the panicked moves, you can look at 1 year's worth of gains get wiped out in 3 or 4 weeks. Or, sometimes it's 3 weeks worth of gains that get wiped out in 1 week. My point is, market goes down a lot faster than it goes up. And when it starts going down and making these impulsive moves to the downside, impulsive by just big drops, you've got to turn to a sentiment. Hey, our earnings beats members know when we talk about the VIX getting up into the upper 30s, if you look at and I'm going to talk about the VIX in just a minute, but the VIX getting up in the upper 30s marked each of the bottoms so far in 2022. Sentiment. I use the VIX and I use the equity only put call ratio. But my point here is, do we need to see the 5-day moving average of the equity only put call ratio get to 0.80? It would certainly make me feel a lot better. And by the way, if you're going to get there, look at what happens when you make these moves. Big drop, big drop, big drop, big drop, big drop, big drop. You don't get there by going sideways or gaining strength. You get there based on the market moving down, because that's when everybody gets fearful. So, do we need one of these to mark a major bottom? I think we do. So if we start rolling back over again and we do ultimately break down again on the S&P and we take out the low we saw in February, this is going to be a really important chart to watch. Now, if you want to see how improbable it seems that we're going to get a 5-day moving average at 0.80, let me show you my next chart. Here's the last 2 years. The daily closes of the equity only put call ratio. Since May of 2020, we've had 1 day where we traded where equity only put call ratio was above 0.8. That was probably January 24th low, that panicked low. 1 day in the last almost 2 years have we gotten to 0.80. But do you notice that the daily, if I could do a trend line or a channel, you kind of see how we're channeling higher in the sentiment the last four months or so? Because growth stocks, technology, discretionary stocks, they all started moving lower back in November and December. So we're starting to slowly see this creep back up. And after not coming anywhere close to 0.8, actually in January, this was actually January 24th low. I may have said February. But the January 24th low, you can see we finally went back up and touched a level we hadn't seen in a couple years. So we're moving in the right direction. We are resetting sentiment right now as the market goes through this volatile period. But we can't fast forward through it. Everybody wants just for it to be over. And I'd love for it to be over too. But I think, my gut tells me, many of these charts are telling me that we're just not there yet. That we're not just going to go back to where we were several months ago and get these equity only put call reading. We had some of these daily readings. Here's one at 0.34. Many in the 0.3s. Look, just recently, last week, I think a lot of it was Max Payne related. It actually benefited market makers. But look at what the retail traders all of a sudden are doing. They're thinking, okay, we're back to, we're back in the game. Here we go. We're going higher. Equity only put call readings now back down the 0.4s. We've had, we had one last month. We had one in February before the market went lower again. We had them in January before the market went lower. And here we are having another one in March. It's like we're stubborn. Humans are stubborn. We don't learn lessons very well. We keep committing the same mistakes over and over and over again because that's what we do. Sentiment is really important to watch. So what's it going to take? We saw what it took in January to get a 0.8 reading. What's it going to take to get a 5-day moving average? What's it going to take to get this 5-day moving average up to 0.80? It's not going to be 1 or 2 down days. I can promise you that. It's going to need to be something that is going to scare a lot of folks that aren't used to being scared. Actually, let's see, did I go over this chart? Yeah, I went over this chart. Okay, so let's move on to the VIX, final sentiment chart. Only thing I wanted to point out here is normally when you see the market move up, the VIX comes down. When you set new highs in the market, and I'm talking about the S&P 500, the VIX normally puts in new lows. Look at the high in 2011, and the VIX comes down, sets this low. 2010. 2011, we set a new high, and here's a new low in the VIX. 2012, we come down here, we put in a new low as we set this new high. 2013, we're rising, VIX sets new lows. 2014, VIX sets new lows as the market goes up. 2015, we kept going higher, but all of a sudden the VIX went back up in the other direction. Maybe a little bit of a warning sign, I don't know. And then all of a sudden we had the pullbacks in 2015, 2016, we got the spikes in the VIX. And then eventually we broke out, and guess what? The VIX went to new lows. Well, the low went to single digits back at the beginning of 2018. And since then, the combination of the trade war, the pandemic, and now what we're going through in 2022 with rates going up, the Fed getting more hawkish, inflation surging over the last year, the Russian-Ukrainian conflict, I think a recession that's probably going to hit. All of these things, I think, are causing the market to remain very nervous, which overall is not great. I mean, if you look at 2020, 2021, the market rising, you can see the VIX was coming down. But at each one of these major highs, here, well, actually here, 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 and here, all four, and actually even here, all 5 of these highs saw higher VIXs. That's not the way the market usually works. It's just telling us that while a lot of the individual traders in the options world are jumping in on calls, the expected volatility, that's what the VIX represents, is it's the expected volatility based on premiums on short-term options. That expected volatility keeps rising. And so when I went into 2022, one of the things I said in Market Vision 2022 is get ready for volatility, because the charts are telling us the market's nervous. And if we actually start to break down like we have, the market's going to get more nervous. Look at the VIX going up. So just understand what we have on our hands, which is wild volatility, what looks like a big breakdown in the market, followed by a big rally, followed by probably another big breakdown in the market, followed by probably another big rally. And that's what we're having to deal with in 2022. And to be quite honest, I just want to get out of the way. I would love to see, again, I don't want to see the market go down because I don't want to see folks getting hurt with their 401ks and all. But at the same time, I think for the longer term stability of the stock market, I think we need it. I think we need to see this market come down, really scare folks that haven't been scared before, all the new people in the market the last 2 years. I think that they need to understand what a real nasty period looks like. And I think we could see it here in 2022. I still don't think we're quite out of the woods. So anyway, that's the VIX and that's sentiment. So the last thing I wanted to do is talk a little bit about these cyclical bear market bottoms. What I have done, and I had an event last month where we did an anatomy of cyclical bear markets. And we went back and we looked at those from a decade perspective. So I pulled up the 1950s and I showed the cyclical bear markets in the 50s. I did the same thing with the 60s. the 80s and the 90s, and then the 2010s. I didn't look at 1970s and the 2000s because there were no cyclical bear markets. Those were both secular bear markets. That's when the market doesn't do well for a long period of time. We're not talking months, we're talking years. When we topped on the S&P 500 in 2000, we didn't see an all-time high again until 2013. 2007, we might have gone just slightly above it and then kind of put in a double top. But it was until 2013 that before we had a meaningful breakout. 12 or 13 years. Do you think that would have changed your strategy had you known that in year 2000? I think it probably would have. If you knew, if somebody said, listen, this is the highest the stock market's going to be in the next 12 years, I doubt you would have remained fully invested in the stock market. But these other bear markets that I'm talking about, and the ones I'm going to show you, are cyclical bear markets. They are within long-term secular bull markets, short-term cyclical bear markets. And these are all the 20% variety. I only concentrated on those. We had some others that were 14, 15%, similar to what we have right now. 1952, I think, or 1953. There was one that was about 15%. I think there was another one maybe in the 80s. I don't recall. But anyway, I'm just going to focus on what we saw. If you look at 1957, we had the move down. And by the way, every one of these cyclical bear markets that I'm going to show you all started from an all-time high, or pretty close to an all-time high. So here, the S&P 500 was trading at just above 49. We went all the way down to 39, 20% lower. And we did so. I think this is important. Keep in mind how long these bear markets last. This one lasted about 3.5 months from top to bottom. Now, we had a lot of choppiness over the next several months, and it was many months before we got back to the high. So when I say the bear market only lasted 3.5 months, I'm just talking about from top to bottom. Doesn't mean that we didn't have some really trying periods going forward after the 3.5 months. So this was 1957. How about 1962? This was the next bear market, cyclical bear market. And by the way, 1950s and 1960s were a secular bull market, long-term 20-year bull market, short-term cyclical bear market within that long-term period. You can have bear markets in an overall secular bull market. That's what a lot of people don't get. They think every bear market's the same. No, they're not. Most of these cyclical bear markets don't last very long. They tend to be very short-lived. They tend to maybe go, coincide with a fairly mild recession. Sometimes the market looks ahead, and sometimes we'll price in a recession, and then the recession hits, and by the time you know it, the stock market's already, rebounding again. So here, 1962, top to bottom, 29.5% in about 6 months. Never went lower again. Now, look at this. Almost rolled over, looked pretty bad. Probably would have scared a lot of folks. You think, okay, here we go again. But it was a head fake. We held on, ended up going higher. That was ultimately was the bottom in 1962. Next bear market. And again, we're skipping the 70s. That was a secular bear market. So 1980s, we began. 1980s and 1990s were a secular bull market. Now this one, because it was right at the beginning of the 1980s, is it part of the secular bear market? Is it just an extended cyclical bear market within the start of a new secular bull market? I don't know. This was kind of an unusual. And there were 2 recessions, I think, in here. I think there was a recession in 80 and then another one in the period 1981 to 82. So there were a couple of recessions in here. But this lasted, look at this. This lasted a year and a half, more than a year and a half, probably close to 20, 21 months. But I would say the first, down to this low here, this was over maybe the first 9 or 10 months. And that was most of the selling, but we did end up going lower, two more times. I think sometimes coming out of secular bull markets, this is when you might tend to have a little bit more of a continuation lingering effect of what you experienced. I mean, we did the same thing coming out in 2009 from the bottom, 2010, 2011. You know, we kind of tried to rally strongly, and then we had these almost like aftershocks. And so maybe that's what this was a little bit. This is really unlike all of the other cyclical bear markets. That's my point. So I don't think it's going to play out like this. You know, time will tell. The next bear market was in 1987, very similar to the pandemic. Very quick, snap your fingers and it's over almost. This occurred from the end of August to the middle part of October. So less than 2 months, 7 weeks, maybe, top to bottom, done, 36%. And I say similar to the pandemic because we did that in 4 weeks and also right around that 36% level, maybe it's 35%. But the bottom was in. Now that didn't make it any easier to trade the next couple of months. It looked like, okay, here we go, rolling over again. And then we battled back and then we rolled over. But ultimately that move to the downside marked a significant bottom. 1990, this is probably the one that I'm looking at the closest to what we are experiencing right now. If you think about it, we're, you know, back in 1990, we were 3 years after that 87 crash. So we had that big recovery off the 87 low, big reaction in the S&P 500 from the 87 low to where we were at the start of this bear market, this cyclical bear market. We also had in 1990, the Persian Gulf War kind of breaking out. It started in August. So it started right after this bear market began. That's when the Persian Gulf War started. I think it was August 2nd of 1990. Another interesting fact, crude oil from about, well, during this period when the market was going down, crude oil spiked 147%, $17 a barrel to $42 a barrel. And then you know what? Crude oil came right back down to $17 a barrel after the, well, it was kind of while the conflict was still in play, because I don't think we actually ended the conflict until sometime in 91. I don't remember when, maybe April or May, something like that. But, you know, we had this drop. This was about 20%. So we had, you know, these different moves. Here was a big rally up here. You know, after we'd had a big drop, we didn't get through the 20-day, but we got tested it, went back down, set a new low. Here we went through the 20, didn't get above the prior high. And that's kind of a theme with a lot of these is that, you know, wherever our previous reaction high is, many times we don't break out. And when we finally do, that's usually a pretty good sign. So like here, this move up, new low. When we finally cleared this, it was all the way up in here. This would have been a head fake to the downside, but that prior bottom held. And then look at this move back to the upside. And I can promise you, we still had the war going on. We had a recession going on then. All of that was occurring while the stock market was having a melt up. The stock market will bottom before all the bad news comes out. That's really important to understand. And that's why, and look at this, this went on for what, 3.5 months. This bear market lasted 3.5 months, maybe just a little over 3 months. And that was it. Now there's a lot of choppiness, a lot of nervousness for the next few months. So imagine us maybe going down one more time, maybe putting in one more low, and then over the summer kind of bouncing, but then okay, coming back down, then kind of bouncing again and scaring us all, not really knowing which way it's going to go. But I believe we're in a long-term secular bull market, which tells me that this cyclical bear market is not going to be a long-term thing. It's going to be probably in this 3 to 6 month variety. 1998, part of that 1990s huge move to the upside. You know, it always looks easier when you're looking back. Oh yeah, but that was just a little thing in the 1990s, you know, market was going up. Well, it wasn't a little thing when we were in the middle of it in August and September of 1998. I mean, the market S&P 500 had reached almost 1,200. And at the very low, we were back down under 9.25. Yeah, people weren't thinking, oh, this is just, you know, a little pullback. At the time, it was like, oh, this is it. You know, the market's going way down. Well, it didn't. We actually rebounded, went right back up again. So this one lasted 3 months, down 22% in 3 months. Notice here, we got all the way back up to about the 50-day and got back to the prior breakdown. And then we had another leg lower that printed a new low. I'm sure everybody was feeling pretty good during this rally. We rallied from 930 all the way back up to about 1070. So what's that? 15% in 3 weeks? It's over, right? All the selling's over. The carpet got pulled out from underneath everybody. And 2 weeks later, we were at a new low. Maybe 3 weeks later. So again, we could be right in this stage right now where we just saw the rally. And now we have one more swift move to the downside. I'm just saying it's a possible, or it's a possibility. You know, don't rule out anything with the volatility index where it is right now. There's nothing telling me right now that we have smooth sailing ahead and we're just going to go straight up. If I was seeing that, I would be passing it along. That's not what I'm seeing. So I think we could do, you know, all kinds of different things. Again, maybe we've bottomed, and if we do, and we go straight back up, it wouldn't be unprecedented. I mean, when we finally did have the bottom in October of 1998, we went straight up to a new high. And by the time we started, and by the way, this was the fourth quarter. I think fourth quarter of this year is going to be strong, but we've got a lot of things to price in between now and then. We'll see. All right, let's keep moving because I've got a couple more of these bear markets and we'll wrap this up. This was 2018. So again, skip the 2000s, 2000 to 2010. Of course, we had those two huge bear markets. That was part of a secular bear market. So now we've broken out of that. 2013, we made new highs, remember? So now we're in a secular bull market. And in October, beginning of October of 2018, trade war. Moved down, little bounce, moved down again, bounce. Couldn't get through that double top, or we set a double top. Came back down, double bottom, came all the way back up. Looked like, here we go. We're going to break out. What happened? Big move. And you remember what happened here? December of 2018, the Fed said they were going to raise rates twice in 2019. They were calling for 2 rate hikes. And I wrote an article. You can go back in my archives, in my Trading Places. I'm pretty sure it was in Trading Places. And I'm almost positive it was on December 26th. It was either the 24th or the 26th, but I think it was the 26th. And I wrote an article and I basically said the Fed would not raise rates. And in July of 2019, they lowered rates. They never raised. They said they were going to raise twice in December. So if you think you're going to just take the Fed at its word, sometimes it kind of gets what it wants by just threatening to do things. Like right now, it's threatening to raise rates 9 times. I mean, I would lay odds that the Fed does not raise interest rates 9 times between now and 2024. Or actually, I think it was now in 2023. They were going to do it 9 times this year and then three times next year. So maybe it was 12 rate hikes in the next year or year and a half. I would lay odds that they're not going to raise rates 12 times. I've said a couple, maybe, they've already done one. So obviously they're going to do one. They're probably going to do another one next month. It might be 50 basis points. But by the time next month rolls around, I wouldn't be surprised to see inflation starting to moderate, maybe even begin to roll over. And that may change the outlook for the Fed going forward. So just remember, here on March 23rd, I'm telling you, we're not going to see 9 rate hikes. That would be shocking to me. It would not be unprecedented, though, by the way. If you go back, one of our last big inflation scares was back in 2004. And during that period, we had, I think, 13 rate increases over 2 years. And the stock market kept going higher, by the way. So it wouldn't be unprecedented to see the Fed keep raising and the market go back to new all-time highs. I just don't think with all the other signals that's going to happen, but who knows? This 2018, bear market lasted 3 months. So you're getting the common theme here on these cyclical bear markets. 3 to 6 months is basically it. We bottom from top to bottom in 3 to 6 months. The one outlier was the 1981-82 period. We had 2 recessions we went through. We had crude oil prices still way up. We had interest rates crazy back then. Remember, fighting inflation. Market was kind of crazy. Of course, we're crazy right now too because of the pandemic. This is like a one-off because of the pandemic. We're seeing things that we haven't seen many times. We haven't seen at all. I haven't seen in my lifetime. Some of these huge moves and then moves back to the other side. And then, all the rotation and everything. Never really seen anything like this. But anyway, my point is going through these bear markets. The last one, 2020, this was like 1987. It was a pandemic. I don't think anyone really could see what was going to take place here. There may have been some that, will go out on record and say they called it, but usually most of those people are the same people that have called, 20 of the last two bear markets. Peter Schiff, some of these people who are just, you want to talk about perma, that guy is a perma bear. And so anything he says, I pretty much ignore because he's always sounding the alarm. It doesn't matter what's going on. And then the market goes down in 2020. And of course, I'm sure he's got record of having predicted it. So CNBC brings him on, parades him, like he's some kind of legend, when in fact, he's a broken clock. He talks about the market going down every single time he's on CNBC. And when it goes down, the two times that we've seen it in the last 10 years, he looks like a genius. When in fact, the stock market has gone crazy throughout the entire period. But I could ramble on and on. Point is here, this is another cyclical bear market. I wrote about this. March 13th was the date I wrote, right in the middle of this. I said, I believe we're still in a secular bull market. And I got some emails saying, how can you say that? We got government restrictions, we're closing down, blah, 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 blah. There's no way that this is the Great Depression 2.0 coming. And all I wrote was it's a healthcare crisis. It's not a financial crisis. And, our economy, very resilient. Government took a lot of steps, whether you agree with them or not, printed a lot of money, took unprecedented steps to support the stock market. And I happen to agree with it. I think you should do that. That's one of their mandates. That's why they were created, to help support the market. I mean, look at what the reason they were created back in the 1930s. They were created because of the Depression, because we don't want another one of those. That's the whole idea behind the Fed. So I fully support, them supporting the stock market to some degree because it helps people keep their jobs. There's a lot of good that comes out of it, but there are a lot of folks that just say, oh, they're printing press, blah, blah, blah. This is bad for the market. Well, they're starting to work their way back out, that they needed a stronger economy. They actually wanted inflation. They've been hoping for inflation. They didn't want deflation. So they're getting a little bit of what they were wanting. And now they're going to have to deal with it and try to, do this balancing act, because any rate increases to fight inflation, our rate increases is going to slow the economy and potentially send us into a recession. So it is a balancing act. Anyway, those are all the cyclical bear markets. So now what we're looking at is 2022. And here was the move up. Here was the top. Where's the bottom? Is this it? Was it a 7 or 8 week cyclical bear market? Or have we topped? Notice we haven't gotten through this high. We went down here, made a reaction high, set a new low, and on the way back up, we haven't moved through this. Doesn't this look familiar? I mean, I think it looks similar to some of these other cyclical bear markets, if not all of them. You get these rallies, they look great, but they don't take out the previous high. Now you might say, well, yeah, but it took out this high. Well, this isn't the important high. You have a lower low, a lower high, a new lower low. This isn't the high to worry about until you go down and set a new low. This is the reaction still that we need to get back through that prior reaction high. So it's this move, this reaction, double top, this move, and now all of this is still part of this move to the upside. We haven't cleared the major level in this downtrend. Have we broken a trend line? Yeah, we have. Actually, if you connect the channel, we probably would have turned 3 or 4 days ago, probably middle of last week on the S&P 500. So we broke the channel. That's a good first step. But Do we hold the rising 20-day? I'll get back to what I talked about at the very, very beginning of this show or webinar. Do we hold the rising 20-day on this pullback? Can we break back up to new highs? Can we clear this reaction high? Because to me, that changes really the whole look of this chart. Or there's your low, there's your lower high, lower low. And, if we can break above 4,600, all of a sudden, this starts to look a lot more like consolidation to me, which, we saw this in 2015, 2016. We saw a little bit more, crazy volatility, but 2018, 2019, 2020, all this back and forth action. I mean, if we start to put in, key lows on the 20-day and we break out the new highs, we could go back to 4,800. And then maybe over the summer, we come back down again. This could turn out to be a really choppy back and forth consolidation period. Or we could see one more leg lower and print a bottom. And like I said, I'm thinking that is probably more likely. I'm going to go 60-40 that we're going to put in a new low. Anyway, that's what I had for today. Hope everybody enjoyed it. Hopefully it gives you some more to think about. One thing I do want to point out again, for those of you that may have come in late, we like to run these specials that we have during our webinars. So if you enjoyed what you saw here, if you're not currently a member, I would recommend that for 30 days, you try our service. If you like the way we approach the market, you like the things I've talked about, I think this would be a great time to experience, because if we go down another leg in this market, you're probably going to want to see the daily market report that I write every day. And that you'd be getting it for free for the next 30 days. So you don't really have a whole lot to lose there. And if you happen to like the service, like I said, for the next 2 days anyway, we're going to have this special in play where if you sign up, you could be an annual member currently and you're, about to expire. You can re-up right now for $9.97, which is our regular annual rate, but we'll give you a free bonus month. So it'll give you 13 months instead of 12. If you're currently a trial member, let's say you've been a trial member for the last 3 weeks and you still got another week and a half to go, but you're pretty sure you want to, up and become an annual member, now's the time to do it, because you're going to get an extra month on top of it. Not only will you get the balance of the 30-day trial, so if you expire in 2 weeks from now, your 13 months will start from the end of your trial period. So you're still going to get the end of the trial. We're not going to cut off any of your free time. And the same goes for anybody who might decide to sign up tonight or tomorrow. If you sign up and you really like what we do and you want to make a decision before Friday to sign up for the annual, we'll give you you still get the rest of your 30-day free trial. And then we'll throw on 13 months on top of it. So you'll end up getting really 14 months. So I wanted to just point that out, make sure everybody's aware of that. Love to have you as a member. We got a growing membership, growing community at Earnings Beats. And I think for good reason. I think we do really good work and provide a lot of great information for both individual traders and money managers. We have a lot of professionals that use our service as well. But anyway, that's what I had for tonight, John. We do have another event next week, and that is going to be a members only event. So again, if you're not a member, if you sign up for a 30-day free trial, you'll at least be able to come in for the event next week. And also we'll have our new model ETF portfolio that'll be announced in April around the 19th. So your 30 days will cover that as well, along with everything else we do for our members. So that's what I had, John. I don't know if we have any questions.
Yeah, there are a couple questions. I'm shaking my hand because I've been taking the copious notes. Listen, I'm going to read a couple questions before I do. A couple people asked about the recording. I want to let them know that it'll be sent out. And a big shout out to, of course, Aaron Weber, who just does an outstanding job, including monitoring all these events. She just does, bang up work. Matt Townsend, who's been doing a lot more customer service, just awesome response time. You know me with customer service, I'm like a geek, and Matt really has stepped up. And then Chris Hopkins, who joined us recently, reaching out to the universe to find and bring in more people to the Earnings Beats community. So none of this would be possible without any of them. So I just wanted to mention that. Okay, couple quick questions. Here we go. One observation, fellow said David Keller just had a show this morning on how gold is going to soar. So that was more a comment than anything else. Question, when you see the market is bottomed, what are the stocks that you would buy immediately? I know we don't have time to get into that tonight, but it sort of ties in, Tom, to another question. If growth / value starts rolling over again, would it be better to go into value indexes or just go to cash short term?
Well, I mean, in a secular bull market, not just the current secular bull market, but if you look back at the 80s and 90s, throughout those 2 decades, the NASDAQ outperformed the S&P 500 2-1. In the current secular bull market, from where we began back in April of 2013, when we had that breakout on the S&P 500, the NASDAQ rose again at about a 2-1 clip over the S&P 500. So in a secular bull market, in my opinion, you are always better off in growth stocks. Now, you're going to have periods, and I think that's been the hardest part about this market, for me anyway. 2021 was a good year for the S&P 500, but it was a bad year for growth, which is really weird. But I think a lot of it has to do with the pandemic and the fact that those growth stocks, I mean, look at the ARK funds and look at Kathy Wood, what she did in her portfolios in 2020. The numbers were off the charts. Growth stocks absolutely crushed everything else in the market. Well, there was a price to pay for that, and it happened in 2021 as we saw all the rotation going from growth to value, and many of those growth indices underperformed. And now here we are in 2022 facing still a lot of issues, I think, in the market, and potentially with a recession on the horizon. And I think as we start hearing more and more and more about a recession, I think that could be the thing that spooks a lot of folks into selling and having this one more move to the downside. Okay. So, I mean, it just depends on your time frame. I mean, if you believe the stock market is going to go lower and put in a new low, I wouldn't be in anything. I would be sitting in cash. I mean, probably everything's going to go down. But on a relative basis, if you want to remain invested, just in case, then I think your value stocks will outperform, but probably not go up, if you know what I mean. I think they'll just, go down, but at a lesser degree. And I wanted to make one comment because I mean, Dave Keller is a good friend of mine, and he's a very, very sharp technician. I mean, he's done work for many, many professional firms, and his work is top notch. Whether he thinks gold's going up or down, or I think gold's going up or down, really doesn't matter, because the market is made up of a lot of really smart people on both sides of the trade. Always. Everybody's got different opinions. Everybody's got different thoughts. The fact that I think gold is not a great investment, and the fact that Dave is saying it's going to soar, one of us is going to be right, one of us is going to be wrong. I mean, that's the way the market works. And it may turn out that he's right. I've been having this thing with Greg Schnell. He keeps telling me, Tom, you got to be in energy. You got to be in energy. He's been following energy for a long time. That's what he does. And for many, many years, when we were talking about it, energy kept underperforming. So I looked like the genius. For the last year or two, Greg looks like the genius. I mean, he's been talking about energy and how much higher it's going to go. And he's been right. So you can be on both sides of the trade, still have a lot of knowledge. And I respect all these technicians at stock charts. I mean, these are folks that are looking at the price action. They have their own way of looking at the market. I have my own way, and that's fine. There's nobody I respect more than John Murphy. And there are times that I read John Murphy's stuff. He started writing about stagflation a week ago, and I'm thinking, I don't think that. But that doesn't mean I don't think John Murphy's a genius. I think he's a genius. And if he writes about stagflation, it's probably something you should be thinking about. But again, I won't necessarily agree with him. So sometimes I get emails and folks will say, well, Greg Schnell wrote about this today, or Aaron Swinlin is thinking this, or, Dave Keller did this. I don't really have any comments other than to say I respect the heck out of them. I think they're all great technicians. And if they're saying something, I think it's worth considering in your own portfolio. I mean, that's really what we do at Stock Charts and what we do here at Earnings Beats is we're just trying to give you food for thought, use our experience, use a lot of the things that we've learned over the years to hopefully help you manage your portfolios and your wealth better. That's the whole idea.
Okay. The only cyclical bear market that took out the 50-day moving average is 2018 and this rally. I'm short now. Where would you put a stop?
Well, I mean, I don't know what he's shortened, but if it's, or she, but if it's a move through, if it's on the S&P 500, that 4,600 level, I mean, I think if that level gets taken out, I mean, sure, we could have whipsaw ahead, but that to me really changes this downtrend, that, picture that we're looking at, and turns it more into sideways consolidation. So I'd have to say 4,600 on the S&P 500 is a number that I would be really uncomfortable holding short positions through.
Let's wrap up with this one. Thanks, Tom. Unfortunately, by the time the charts confirm the bottom has been printed, the best opportunity to get back, it is long gone, and much of the recovery opportunity has been lost. Do you agree with this?
No, not at all. I mean, that's the same thing as saying, well, by the time you realize that, there's a recession and there are higher interest rates, it's too late to get out. I mean, we talked about the weakness ahead back in December when the S&P was at an all-time high. So I don't think that necessarily you have to wait for the market to bounce. I mean, I'm going to be looking to buy when the signals are telling me to buy, not when the S&P 500 is going higher. I mean, this rally that we've seen, I mean, we talked about the potential of a short-term move higher last week with Max Payne. So I'm not surprised we moved higher at all. There was a lot of money on the table, billions, $5 billion on just the QQQ and the Spider. Just those two ETFs had $5 billion of net in the money put premium at the close last Monday. And by Friday, it was probably down to a total of 500 million. 90% of the put premium was wiped out in 4 trading days. Now, if you want to look at that and say, well, the bottom is in, and now it's too late, and we go higher. I mean, we could go higher from here. Listen, I firmly believe we're in a secular bull market. So I definitely think we're going higher. It's just a question to me of whether or not we have one more move to the downside, and whether or not we hit that, 20% quote unquote bear market threshold for the S&P 500. A lot of these growth stocks have been hammered. I mean, even Tesla, if you told me you've got to, today is your only window to buy and you got to hold for 2 years. So if you're going to buy, you have to do it today. Would you buy Tesla today? I'd say yes. I mean, even though I think it could go back down to 700 again, I would buy it if I knew I couldn't have any other opportunity to get in, because I believe we're in a secular bull market. And I think Tesla is a great company. And I think ultimately it's going to be an all-time high again. Is that going to happen later this year? Is it going to happen later next month? Is it going to be 2 years from now? I don't know. But if I was pinned down, even though the market's rallied here, I would still be a buyer because of my secular bull market thesis that I'm kind of going under. But I do think in the short term, I mean, I just showed you all the cyclical bear markets. And while we might say, hey, this one is the only one, or only one of 2 that's gotten through the 50-day moving average, how many of them got through the reaction highs? Because we still haven't gotten through that 4,600 level on the S&P 500. So as far as I'm concerned, price action is much more important to me than moving averages. If we can get back through that reaction high at 4,600, then I'm going to begin to think that market bottom was in. And then that completely changes the way I approach the market. But for now, I'm not ready to make that call.
Okay. I actually got one last question then, folks. We can't take any more, but I want to try to get this one in. Tom, the uptrending long-term US dollar chart you showed looks to me like the trend broke and is now back testing. Why do you believe it will break back above the trend line and move higher? Thank you.
Well, I mean, first of all, trend lines always get broken. Let me pull up that chart because I think I know exactly. That was on the dollar, correct?
Yes.
Yeah, so I think what we're talking about is this trend line right here. First of all, there are only 3 points on the trend line. A trend line is only as good as the number of times that it hits that trend line. So a trend line that's touched 20 times to me is much stronger than a trend line that's touched twice, because I can literally draw a trend line anywhere if I'm connecting 2 points. 3 points makes it a little bit better. And I mean, we could argue there's more than 3 along here, but for the most part, it's this low, and this low that are attached. What I've said before is price. To me, price support, price resistance is more important than anything else. It's more important than trend lines. It's more important than moving averages. It's more important than anything. The dollar is in an uptrend, I believe, because we're putting in these higher highs, higher lows, higher high, higher low. I don't know if you want to call that a higher high, but technically I think we did go slightly above that prior high. So at a minimum, we've got to take out this low. And that's why I have this support level drawn in here. So yeah, I mean, we might be back testing this prior trend line, but as far as I'm concerned, we're sideways consolidating in the dollar. We have highs that I think you can see double top right here at about 103, 103 and a half. We've got to get through that to the upside. To the downside, we've got this triple top right here that we broke out above. We went back basically and tested it. If we don't go below 88, we're still holding on to price support. This sideways consolidation could go on for quite some time. I mean, if you look at a chart like Amazon went up, had a nice channel line for a while, and it broke, and then it just went sideways for a couple of years. I don't think it's bearish. It's just sideways consolidating. So what I'm looking at with the dollar is the other chart I showed you, which was our yield in the US versus Germany, has continued to move higher. That's telling me that the US economy is being viewed stronger than the German economy. US versus Germany, US versus Europe. Well, that tells me that the dollar probably is going to remain stronger as a result of this. Now, if all of a sudden we start seeing this yield spread between the US and Germany start shooting to the downside, then I'm going to begin to question the dollar rally. And, at that point, maybe some of these things that I talked about today changes. But I think for right now, I'm pretty comfortable with the fact I think the dollar remains in an uptrend, just simply that it's in a short-term uptrend within more of an intermediate or long-term period of consolidation. So I'm assuming that is it.
That's it.
All right.
Great job. Thank you.
Yeah. Appreciate everybody stopping in. It was a very well-attended session. I think it's timely given everything that's been happening. Just be careful in the market. I mean, again, I think the market's going higher, but I don't want to say, hey, you just jump in knowing that some of the signals are still telling me we might have one more low. I think if we get another leg down, it could be swift. And if it's swift and we get a big drop, we move into the 3000s, I would be using that weakness to jump in. And that's what I'm going to talk about a little bit next week at next week's event, is how we play this subsequent recovery and resumption of the secular bull market. So I think that'll be really a powerful presentation. You do need to be a member for that, though. But again, consider the 30-day trial if you are new to Earnings Beats. Anyhow, everybody have a great day. Appreciate you coming in, stopping by. We do like to do these events from time to time, and that's one of the reasons why I think it's really powerful to at least be part of our EB Digest community, which is our free newsletter, because when we have these free events from time to time, we always reach out to that group. So again, thanks everybody for your support, whether it's free, whether it's paid. Obviously, we wouldn't be doing what we're doing without our paid members. So we really appreciate the folks that pay us for our services. But again, everybody have a great day tomorrow, evening tonight, and hopefully the market does whatever you want it to do. Just be careful out there. Still a lot of warning signs. Happy trading, everybody.